Okay, so today's session is on inflation, deflation. Thursday, the 21st of April, 4 p.m. GMT. This is Ron William, Principal Market Strategist from RW Advisory, talking about one of the hot topics for some time, but more so into the second half of this year, or even the second quarter, and then the second half of this year of 2013. Those of you that want to ask any questions, just feel free to maybe email me because we're just tight on time at the moment on ronwilliampr@gmail.com. So just feel free just to shoot me an email afterwards with any questions. But in the meantime, I'm just going to quickly jump into the session just so we can save as much time as possible. Okay, so the first thing that we always start with is the technical approach, the one that I've been using for several years. And for those of you that have attended these sessions before, you would know this slide pretty well. It's just basically based on a macro approach where we start with the top level, high level, big picture, and then work our way down. And that tends to begin with the macro filters, things such as cycles and certain intermarket relationships. And once that roadmap is identified, then the next level is market internals, so technical indicators and also fundamental indicators, a fusion of the two. And then finally, last but not least, for certain entry and exit setups, timing is everything, and within that, certain patterns and also indicators are used, such as the market indicators. Okay, now each of these sessions every month are pretty much global. I think many of you are attending from different places around the world. So what I'd like to do is to kind of leverage some of you, each of you that are attending today, and just find out a little bit about where you're from and what markets are important to you. So I always ask this question, each of you could just please introduce yourselves to each other. Which country are you attending from, and what markets or strategy are important to you? If I could also just ask the last thing, if you just tell me if you've attended my sessions before, if this is the first time. So which country are you attending from, what markets are important to you, or market strategies, and is this your first time or repeat time to be attending these sessions? I'll just wait a moment or two for everyone to confirm. So Boyke's repeat attendee, one of our loyal ones from Africa. Anyone else? Pan on Fire, UK Forex, from the UK, I think, Forex, US stocks, first time swing trader. Gregorian from Poland, James Brown from the UK, first time welcome. Gam from the UK, hey, welcome back. PM Miners and Biotechs, FX and Gold. Chuck, let me just try and open this because I can just barely read it. From the US, Money Markets and Statistics, regular. Ali from Iran looks at FX. Nicola from Serbia. And then Ahmed from UK FX, and finally Wang from China looks at the euro. So we have got an extensive kind of global attendance today. Welcome to some of you that are here for the first time, and thank you very much for those that are repeat attendees. We literally have the globe kind of global participation here, so that's always an honor and a pleasure. I'm based in Switzerland, and each of these sessions tend to be held here unless I'm traveling in another country. But what's great is that each of you represent the world collectively, and different perspectives, different markets, which are important to each of you. So what I always like to do is to try and encourage each of you to interact and to ask questions, because I'll just give a general outlook, but then each of you will have your own specific questions specific to the countries that you're in and the markets that you look at. Okay, so this is what we're going to be covering today. Just a quick 3-session segment within the time that we have remaining, and that is part 1, where I'm going to ask each of you the question: what are your expectations over the next few months and maybe over the next few years, inflation or deflation, or both? I want to then work out just a quick definition on inflation, key causes, and then the comparison between inflation versus deflation. Part 2 is an introduction to a very important methodology that you can follow, the business cycle, which has been developed over the years by the veteran technician Martin Pring, where he tracks 3 key asset classes: stocks, commodities, and bonds, and tries to basically identify which assets are the best ones to invest in according to the stage that the economy or the business cycle is in. And finally, part 3 is just a quick section where I just want to highlight a few macro risks which may lead to inflation or deflation over the next few months or over the next few years, depending on what your expectations are. And those shocks I've only kept it to 2. Energy shocks from the oil market, primarily down to geopolitical risks, and then currency devaluation, of course, from the extensive money printing which is taking place in Western economies to try and save their economies from the debt situation. Okay, so part 1, 2, and 3. We'll start with part 1. My first question to everyone else here, from each of the countries around the world: what are your expectations over the next few months and next few years? So if I was to say multi-month and then multi-year, inflation, deflation, what are your expectations and why? Why do you think we might see inflation or deflation over the next few months or years? If you could give me both time frames, just in case you have a differing view, and if you have a view over the next few months or years, just let me know. So Ahmed is saying inflation due to QE, so quantitative easing, devaluing our currencies, but also leading to potential inflation on the back of the debt, which continues to increase. James is saying inflation due to an increase in the money supply. That's a good point. One point I'll make on the money supply is the velocity of money. The circulation of money is key, and although money supply has increased, we need to see the velocity increase, and I'll say a word or two on that. Daniel is saying inflation because of money printing, so similar to the QE point. Ali is saying inflation due to money creation. And then Nicholas saying inflation, money printing. So we have a big consensus for inflation for the same reasons. Gam is saying stagflation, interestingly. Consumers are still running scared. Inflation later if the stock market crashes, and QE money needs to be find a new home. So Gam's slightly different from each of you, still going for maybe the inflation case, but maybe with increased unemployment. And then Pan on Fire is saying expect deflation initially and then inflation. If I could ask Pan just quickly if you could give me a cause as to why do you think we might see deflation initially and then inflation. Just interesting because you seem to have a unique view to everyone else. Pan, if I could just ask you the reasons. Why do you expect deflation now? Money printing to ease initial pressures. That's a good question. So Borky's asking which countries. I'm probably alluding mostly to the Western markets, so the US and Europe, but probably US as a case in point. I think most people are looking more at the US at the moment as an important benchmark. But obviously there is a big difference between what is happening in the States, Europe, and then of course Asia. But largely this would be US and Europe. And if either of you have different country focuses, feel free to say. But I'm mainly talking about the US markets and then potentially Europe. Okay, so most of you are having an inflation expectation over the multi-month, multi-year, and only I think 1 or 2 of you are looking for a mix of the two. I think Pan was looking for a mix of the two. And then Gam is suggesting potential stagflation. Gam's also saying, I think all countries are heading for a very nasty place by different paths. So Gam, you sound generally bearish on the global economies, and then time will tell. We'll see. So I think the honest answer is We don't know. It's a big question mark, and this is why it's such a hot topic, and why I wanted to choose it for today's session, just to ask some important questions, and then we can continue to monitor this topic and particular monitors, just to see particular proxies, just to see how this might play out. Okay, so the key thing is, what is inflation? Everyone talks about inflation and deflation, and I always think it's a good idea just to actually start with the textbook definition. The problem is there are many definitions, so I'm just keeping it simple, and I've just picked 2 definitions. Inflation is basically the substantial and rapid general increase in price. So if basically your cost of living is rising significantly, whether that's food, whether that's energy costs, so your heating bills, your petrol for transport, and so on. If that's increasing, then that's generally a sign of inflation, rapidly increasing prices. But on a consumer basis, you can see that in your cost of living. Also, another sign of inflation is the decline in the value of money, and that's something very much driven by governments in terms of the quantitative easing that is taking place in the US and Europe. The consequence of that is a decline in the value of the country's money, and hence a potential inflationary pressure at some point in time. Now, the ways that you can measure either type of inflation is wholesale price index, which basically measures inflation but based on corporations, businesses, whether it's more expensive or cheaper for them to actually wholesale productions or items. Consumer price index, where that's more specific to individuals like you and I, and the cost of living. Now, types of inflation. This is important. I'm not going to go into each of these situations, but I'm just going to quickly highlight what might be interesting. You have credit inflation, currency inflation, scarcity inflation, deficit inflation, profit inflation, tax inflation, and cost inflation. I'll probably ask each of you, what type of inflation or mixture of inflation problems do you think we have? Credit, currency, scarcity, deficit, profit, tax, cost. Keep in mind that some of these different inflation variables are positive and some of them are negative. So Ali Reza is saying deficit inflation. I think that would be very fair. Fair point to be saying. Anyone else? So deficit inflation. Let me just quickly highlight that. So if we're seeing deficit inflation, then we're not seeing profit inflation, because of course that's the inverse. Credit inflation, we're definitely seeing credit inflation. Anyone else? Cost inflation, yeah. I mean that's also a consequence. So the costs for consumers, but the costs for companies as well. And tax inflation, we're also starting to see that. If your income tax or your corporation tax is increasing, then that's also an issue. Currency inflation, I'm not too sure about at the moment. I mean, that's a risk. Whether we're seeing that or not is another question. But it's also interesting to look at past examples. For example, markets like in South America and Argentina, case in point, where they had very extreme currency inflation, and of course there are other examples to that. But currency inflation is probably a risk in the future, either in the short term or the long term. Time will tell. But certainly currency inflation is the big risk that everyone is talking about in terms of quantitative easing, and how all the governments are printing money to support their country deficits, and then that long-term risk for currency inflation. So currency losing value, but as a consequence, creating inflation. So there are different types of inflation to keep in mind. And it's a word which is used very frequently and very, very loosely, either if it's just between friends or professionally at work or on the television media shows. So I would encourage everyone just to kind of research the different types of inflation and the effects of each of those inflations. Pan's saying, this is making me think, it hurts. Very good point. I mean, it's just good to understand that inflation can be positive as much as it can be negative, and that whether it's positive or negative, depending on the drivers of it, it then gives you an idea as to what the effect might be, and then obviously how you can try and protect yourself in either of those scenarios. So I encourage each of you to actually research the different types of inflations, positive and negative. Inflation is not just negative, it can also be positive. Obviously, a lot of people are more worried about the negative effects during recessionary times and during big deficit situations as we're experiencing in the US and in Europe. So we just highlighted credit inflation, which is currently true, currency inflation, which is more of a long-term risk, deficit inflation, which is a current risk, and then of course tax and cost inflation, which we're already experiencing, but we might increase later on. Daniel K. saying inflation is a necessary evil to the economy. How can it be positive? Well, it depends. If a country is going through an expansion cycle, I don't have any historical examples with me at the moment, then inflation can be a good thing. Of course, it needs to be steady inflation, not runaway or hyperinflation. But a healthy amount or a steady amount of inflation can be good for a growing economy. Of course, if the economy is actually in debt, it can be positive to decrease debt, but it all depends on the, let's say, on how healthy that economy is, on whether the economy is actually producing enough and consuming enough in order to grow itself out of that debt, while it's also decreasing the percentage of the debt. Of course, the central banks in the US and Europe believe that inflation can be healthy for reducing the government debt, but the key point there is you do need economic growth for that equation to balance. Just having inflation by itself is just one piece of the puzzle. You also need economic production. You also need economic consumption. You need people to be, in business, producing products and hiring people. If you don't have that situation, then it can be very negative. Is that clear to everyone? I'm just giving a very high-level answer to some of these questions. Is that clear? I think it was Borky asking me. Right, okay. So I'll move on to the next slide. Next point is the effect of inflation. And it's probably obvious, but I'll just highlight it just to be clear. Debtors and creditors. Of course, if corporations have any bank loans, or if any of us have personal loans, and inflation, a significant increase in inflation triggers, then the interest rates, obviously, on a lot of that fixed income that may have been borrowed goes up, and then of course the debt situation starts to balloon. Fixed income investments, just people that are actually investing in long-term secure investments, may have issues, especially if you believe in this potential bond bubble that may break out. Consumers, obviously, that they lose their purchasing power during inflationary times. So just think of the basic products that you might buy, food to eat, or energy to heat your home or to drive your car. Consumers do lose their purchasing power. The value of their money decreases essentially. Producers and businessmen, it's a case in point. So sometimes they'll need to consolidate, or their costs will increase, so they won't be able to afford to invest as much as they may have done during good times. Agriculturists, which often get understated, but just think of the farmers and agricultural prices actually rising. So we're not just saying general inflation, but also just think of wheat, corn, rice, just general food inflation, and that can be quite catastrophic for some developing markets, such as North Africa, where you're seeing a big revolutionary wave taking place, and some of that is on the back of agricultural prices tripling in value in a very short space of time, and then obviously a big part of their population not being able to actually buy food at the traditional prices, and the farmers are obviously finding it very hard to actually continue to stay in business. And then finally, taxpayers and the government, their revenue streams start to decrease, and of course they might start to increase taxation, or of course reduce government spending because of the potential austerity measures that need to be put in place during inflationary environment. Any questions on any of these points? I'll just wait a moment if anyone has any questions. Okay, I'm going to speed on to the next slide now. Just want to talk about the comparison between inflation and deflation, because I've only been talking about inflation. Inflation is the value of money falling and prices increasing. Both tend to happen, but it's maybe two different ways of looking at it. Redistribution. Meanwhile, deflation is the value of money rising while prices are falling, so almost the inverse. You get a redistribution of income, wealth in an unjust manner, but national incomes rises. And deflation, it's a reduction in national income, so most people get affected. And this is just a high level, just general explanation. Inflationary times, employment adds pressure to the economy, whereas deflationary times it tends to decrease the employment picture. So you tend to get more unemployment during deflationary times. And of course, this is just a very general definition or general points. It's probably best to go back into history in the 1930s and see what happened during the deflationary, depressionary times, 1970s when it was inflation, hyperinflation. Or Japan, for example, as a case in point during the 80s and 90s where they had a lot of deflation as well. So here's a quick example of Japan over the last 20 or 30 years with a record deflation. This is definitely one of the things that the central banks in the US and in Europe were very concerned about. Probably the top problem and risk that they were worried about is the 1930 style depression, which is the next stage after deflation. But this is just a quick chart here just showing you how Japan is probably the most current or the most recent best example of a country which spiraled into deflation for over 20 years. And of course, now they seem to be, this is not an up-to-date chart, but now they seem to be structurally unwinding from this multi-decade deflation, where a lot of people basically started to save more money. They felt more reluctant or less reluctant to spend money and purchase goods. So consumption generally reduced, employment generally was an issue, and people started to save a lot more. Now, we've covered just quick sentiment in terms of what each of you thought would be the expectation. I think most of you were looking for inflationary pressures over the next few months and next few years. And I think it's more of the popular argument out there based upon what the governments are doing and the big quantitative easing that is taking place. And so a lot of people are worried about the inflationary risks of what the governments are doing. But there are two sides to this debate, and of course it's either inflation or deflation or both. I've covered some of the key causes, which I hope gives some useful information to research after this session, and then just a quick comparison on both inflation and deflation. Now, in the last second part and third part, before we end in the next a few minutes, I just want to talk about part two, the business cycle, which has been developed for many years by the veteran Martin Pring, where he tracks stocks, commodities, and bonds. And then I'll end off on part three, macro risks, including energy market and potential currency devaluation, which most of you have already highlighted. So the business cycle is basically just think of the general boom and sort of rise and fall of market value. But during that time, there's a shift in different asset classes, bonds, commodities, and stocks. So you can just see here the black line just showing you the rise and fall of prices over time. But during that time, there are different stages where you can invest in different asset classes and either protect your money or potentially build on your wealth. So stage one, bonds tend to be a positive investment. Stage two, stocks start to pick up and start to give you a bit more profit potential. Stage three, commodities tend to pick up, and then four, bonds actually start to turn around. So you start to see a decrease in bond value and increase in yields. And then stage 5 is basically when you see a peak in stock prices. I'm not giving you the explanations, by the way, as to why this happens. I'm just going through this very quickly just so you can see the different stages. And then finally, stage 6, where commodities actually peak, and there's a rotation between each of these asset classes from stage 6 back to stage 1. Now, what's important is what I'm about to show you here is that during stage 1, 2, and 3, bonds tend to be attractive. During stage 2, 3, and 4, stocks, and stage 3, 4, and 5, commodities. Now, most, let's say, strategists, certainly Martin Pring, as I understand, and also I agree with his hypothesis, believe that we are actually undergoing stage 4. And this is the key point of the entire session. So if you remember anything, remember this one point that we're making here. Within this business cycle, stage 4, which we're likely in, this is just based on probability and based on current market moves. Stage 4 basically means that bonds are going through a transition phase as we speak, in the sense that the long-term downtrend in bonds, uptrend in bonds, downtrend in yields is about to turn. And so this is something that a lot of people have been waiting for some time, but just keep in mind that there's an increased probability of happening during this stage, and it might be a short-term move, might be a long-term move, might be cyclical or secular. It all depends, but still we should start to see some change, reversal in bond prices, and upside reversal in yields, so higher interest rates on a long-term basis. But what that also means is that stock prices start to peak. So you can see here, if I can just highlight, stock market tends to increase in value, but it increases in value in the final leg, the final up move of its rise, so the final acceleration in its move. So think of it as the terminal phase of the stock market rise. And I'm basing this, by the way, on US stock market mainly. But what you do start to get is an increase in commodity prices. And that's the key point. Commodity prices actually start to extend in both stage 4 and 5. So we still have the big game changer right now is two things. One, we see an extension in commodity prices. So that could be general commodity prices, industrial metals, precious metals, and energy. Specifically, I think we might see that in precious metals like gold, and specifically energies such as oil. So I think gold and oil has a big upside risk over the next few months, and I have my reasons for thinking that. But stocks, the stock market, which is currently making is currently at all-time highs or breaking to new all-time highs in the U.S., that is still likely to be an unsustainable move. It's a very positive move, but we still might get a downside setback of about 20-30% potentially over the next few months. That's my perspective, but I want to put that perspective in the context of this business cycle. So this business cycle is just a template, but the expectations I've put on this template is more my perspective. So is that clear to everyone? Stage 4 is currently what we're likely to be experiencing at the moment, and that basically means that the stock market is still rising, but in a terminal phase of its cyclical recovery. So that means the move above the all-time highs is limited, and we still have a risk of a downside setback. And I think that would be 20-30%, perhaps over the next few months, or into 2014. But during that time, we get a shift in bonds, so we get that major cyclical and maybe secular short-term and long-term reversal in bond prices, which means higher long-term interest rates, so interest rates rising in value, and then commodities actually extending on their next acceleration phase. Now I just want to read the questions just to make sure that everyone's got this, because this is the key message behind this entire session. James is asking, due to massive quantitative easing, is there a decoupling between these factors now? I mean, I don't think so. I think, I mean, it will obviously maybe extend the cycle, maybe, or maybe increase the rotation. Either extends the cycle or makes the rotation move faster. But I do think that the quantitative easing is more of a risk that we'll see more on the medium to long term time frame. So maybe something that we'll actually start to see more risks later on. Gam's asking, do you think stocks could turn before bonds do? That's a tough one. The honest answer is I don't know. I have more of a strong feeling on stocks than I do on bonds at the moment, just based on some cycle analysis that I look at, and also some timing indicators. And right now on stocks, I do have a potential downside risk to the US stock market and maybe the European stock market in July and August. They're the two key months that I'm watching out for as potential downside risk scenarios for the stock market. So maybe that might be one answer to your question. I have more of a perspective on the stock market at the moment in terms of it potentially peaking. Whether it peaks before bonds or not, I prefer to wait and see. Now, I just want to quickly kind of put the economic cycle here, and for some of you that attended this session before, in terms of my outlook session before, I always show this theoretical diagram of 3 cycles: long-term, medium-term, and short-term. Think of the long-term as multi-year, medium-term as 3 to 12 months, and short-term as anything from a few weeks to a few months. So the big fat blue line, the light turquoise line, and then the red dotted line. It's important that we think in terms of 3 cycles, because a lot of these multi-time frame cycles interplay with each other. But just very quickly, if you just look at the peak of this cycle as the peak of 2007, and this is based on the US economy, not so much the stock market, but more the economy, where we had the big capitulation following the boom times. And then we saw the bottom in 2009. Of course, that was also the US stock market bottom, which I think at the moment we're running into 2013 second quarter. I think around about the second quarter, summertime, as I mentioned, July and August, is at least from a cyclical and timing perspective, based upon the proprietary indicators I look at, the time that we might start to see an unwinding in this position. We still might have a long-term upside potential in the stock market, but I think there are still short to medium-term downside risks coming up, and again, that's more in the second quarter. So we've seen this 4-year recovery from the 2009 low, and on the stock market, that's basically the S&P 500 and the Dow Jones Index at all-time highs or above all-time highs. So that move is likely to be unsustainable over the next few months, and thereafter, of course, that downside scenario I mentioned, maybe a 20 to 30% setback, which would be very positive for the coming long-term bull cycle, for us to have that setback. And that could be potentially into 2013 third quarter, or even into 2014. It depends. But I've just theoretically drawn the roadmap as such. Now, what this looks like in nominal terms, I've just put here the S&P 500 as of today, and you can see that 4-year rise from the 2009 low, which is a record recovery on a cyclical basis. We've broken above the 2008 peak, and we're basically breaking above the all-time 2007 peak at around 1576. So this is very positive, and if you look at the stock participation in this move, so the breadth measures, it is also very positive. So small cap, mid cap, and large cap stocks within the S&P 500 are all very positive. So that there's a general consensus in this move, but I'm still keeping in a potential hedge for for some kind of downside risk over the next few months. So this is positive, but I would say at this stage, if you're invested, the risk reward is maybe not as attractive. If you've already doubled or tripled your profits, how much more upside, how much more profit are you willing to stay in the market for the potential risk that might happen, 20 to 30%? So try and think of it from a risk-reward ratio. It doesn't matter if I'm wrong or if I'm right, or if you're wrong or if you're right. Just try and think of it from a risk-reward perspective. Is it really worth staying in the market at these high levels, considering the potential risks that we might see over the next few months? And it doesn't have to be my perspective. It's just think of it from the fact that the market's already very high, and so just based on statistical distributions, there is more downside risk just because we're so high already in the market. Now, the other perspective that can help you understand why this move might be a little bit unsustainable is if you look at it from a long-term perspective, and this is the S&P 500 going back to the 2000s, and what I'm showing you here, you can see here it's from 99. We've been moving sideways basically for 13 years. And although we're extending into or above the 2007 high, it's still one big trading range. So that's not necessarily bearish, but it's not positive either. Of course, from 2009, it's very positive because the market's increased in value considerably. But just keep in mind that we need to. This could also be an important resistance area, important barrier, just above the 2007 high. And what I've been telling many people is it might be wise to have a price and time filter, which basically means if we do break above the 2007 high on the S&P 500 or other indices, we should maybe wait for a percentage move above there, so 3 to 6%, for example, and a time filter, a weekly or a monthly close above the 2007 high. And these price and time filters allow us to filter out any false breakouts. And history teaches us that there can be many false breakouts when we get a really positive, euphoric, exciting move above all-time highs, but it's a short-lived move, and then we get a big flush out to the downside. So just keep in mind that it's always a two-way market, and whether you're bullish or bearish, it's always good to have a hedge either way. Any questions on what I've just discussed so far? I'm going to have to go very quickly through this just because there isn't much time left. So this is just a quick long-term perspective of the last 100 years of stock market performance in the US. And this just shows you that each of these long-term trends, whether it's bullish or bearish, tend to last for 16 to 20 years. So they're generational trends by nature. And what that means is, I mean, if you look at 2000, we've only been in that trend for 13 years. So you could argue that we still have at least we're still below the average long-term cycle duration. So usually it's 16 to 20 years, and we're still only 13 years. So we still could have at least 3 years or so, we could argue, of further sideways price activity. And of course, during that time, the market can be very volatile, as it was during the prior sideways market of 1966 and 1982. And of course, these markets, which are very extreme markets, but let's just say 1966-82 is probably the better comparison in price terms. Either way, each of these sideways moving markets, roughly lasting 16 to 20 years, tend to be very volatile, so swing trading tends to be quite important. Timing is very important. And generally there's a big contraction in valuation, and usually a diminishing effect in terms of the stock market value. Now, remember the business cycle that I was just showing you had the relationship between bonds, stocks, and commodities. I just want to say a quick thing about gold within the commodity complex. Gold is obviously about to break its reaction low at 1522. It may actually break below that, but just keep in mind that on a long-term basis it's still very positive. And based on historical price moves in gold, there is a likelihood that we still get an extension to the upside, which would be very sharp, similar to maybe how we saw in 1980s. For those of you that think that gold is in a bubble, keep in mind that you really will know if gold is in a bubble, because you do get these straight line moves similar to what we saw in the 1980s, and we haven't really seen that yet. And my perspective generally is also in the next few months that we might actually see, the next few weeks we might see a break below 1522, and then that'll flush out more of the short-term money that's been invested in gold. But over the next few months, this might actually create a very good buying opportunity for gold, where we get a very big acceleration to the upside. So just keep in mind that over the next few weeks we might get a short-term downside break, but that might actually create a very positive buying opportunity for the long term over the next few months and maybe into 2014. And obviously this might add to the inflationary pressures that some of you might be expecting, or certainly what I'm expecting over the next few months. Ahmed's asking, will risk currencies, euro, sterling, etc., go down as they correlate with the stock market? I try and avoid looking at correlations because they work sometimes, and then sometimes they don't work. It's good to keep in mind why some of these correlations might be taking place, but I don't look at them for a one-for-one basis. Generally speaking, I would say that some of the risk trades generally are likely to unwind just because they're so overextended, but I wouldn't base that on the correlation with the stock market. Okay, now the most important chart in this entire session is this chart of US 10-year government yields, or long-term interest rates. And here you can see that we've been going down in yield terms, interest rate terms, for over 32 years, from the 1980 peak into the 2012 or 2013 bottom. And certainly we start to see an extension in yields above that 2% level. The average cycle the average long-term cycle in bull or bear markets in long-term government yields is about 27 years. So we've already overextended this trend in time terms, and certainly a lot of you are probably have already spoken about the potential risk to higher interest rates over the next few months or years based on quantitative easing and all the economic and political risks. But keep in mind that also on a cyclical basis, long-term cyclical basis, that this move is very stretched, and on that basis we might see a change. Also remember that when we covered the business cycle, which I'll just quickly go, business cycle was bonds. So bonds is the market that we should really keep our eye on at the moment, as having the big long-term change at some point. Okay, I'm just going to quickly read the questions. Do you think it's still possible to, given the EU declared open season on private accounts, thereby wave starts like on bank runs? I'm still holding out for gold at 1475 though. 1475 and thereabouts might be an attractive level, but I do think that the last reactive low might be broken, just on a psychological basis. And Johannes is saying, do you rule out gold having already bottomed out around 1575? So I would say to Johannes, no. I think that we still might have further lower levels in gold below 1575, and that might create further unwinding of short-term bullish positions in gold. So just keep in mind that it might still get bearish over the next few weeks and maybe months. But potentially during the summer months of this year, when we might see that big setback in the stock market, that might lead to a big upside move on gold, and potentially, in my opinion, the US dollar as a potential flight to safety, depending on what triggers that move, whether it's just a general reversal in the stock market or maybe some kind of market or economic shock. In terms of silver, just to answer Tan's question, I'd say gold and silver are very bullish in the long term. Silver especially, because remember that silver is the evil sister of gold. It's very volatile, and it tends to move much faster than gold. It's a high beta, highly volatile version of gold. And for other supply-demand reasons, I think silver also has a lot of upside potential. Problem with silver is it is very volatile, so it can be very tricky to invest and trade in. But to answer your question, no, I don't think it's bottomed in the short term, and I do think that it has plenty of upside in the long term. But just keep it on US, at least from a time basis and also maybe from an economic basis, might still play out that scenario that each of you are anticipating. Now, the last part, in the last few minutes, I'm going to talk about macro risks, the energy shocks, and currency devaluation. I've only got a few charts here, so I'm just going to be very quick about this. Now, the key thing to keep in mind is that markets do experience highly volatile moves from, let's say, the market mean, and this is a probability distribution of financial market risk. This is more of a realistic, practical probability distribution of financial market risk, where you tend to experience fat tails or black swan events. And certainly I think post-2007 we've been experiencing a lot of fat tail events, a lot of event risk, economic, political, and even natural earthquake, hurricane risks as well. So we've had plenty of risks over the last few years and will likely continue to. So just keep that in mind, and if you're running profitable trades, fantastic, but always keep in mind that the markets moves both ways. And in highly volatile markets, it's always good just to keep a risk scenario, just in case your strategy might be wrong, or just in case you want to protect your profits. Okay, now the big market which I think we should all be watching over the next few weeks and months is literally the oil market. And if you look at here, this is just West Texas crude oil, and it hasn't been doing much for several months. But keep in mind that it's a big consolidation pattern, or the way I like to call it, a breakout pattern. When markets start to move sideways, but the trading range starts to converge in this triangle-shaped characteristic, that does mean that there's an ongoing battle between buyers and sellers. Demand and supply is starting to really get squeezed, and then at some point you do get a massive breakout. Potentially we might get a breakout to the upside, and that's based on volatility analysis that I've been doing and various other cyclical work that I've been doing. Also, if you just look at the general geopolitical situation in the Middle East, that hasn't really eased. That's been increasing if you've been keeping up to date with the news. So, I mean, this is all speculation in terms of the macro and the geopolitical risks, but just keep in mind that at least on a technical basis, this market is about to break out at some point, and then based upon whatever that causality might be, geopolitical or just other reasons, we could see a big move. Now, if we were to see a big breakout to the upside, a big spike in oil, obviously that would have massive impact on the economy overnight. We could see inflationary pressures just on the back of that. Definitely we'd see recessionary risks very quickly, and history has shown us that time and time again. Having said that, a spike in oil, if ever that were to happen for whatever reason, is a short-lived move. But of course, the fact that it's a spike, a very fast move in a very short space of time, does mean that it is the trigger, or it is a potential market shock trigger for all of the sensitive kind of variables that we've been talking about already. So keep an eye out on oil and this potential breakout pattern, either to the upside or the downside. I'm currently envisaging a potential upside breakout based upon my own analysis. Now, this last point is the currency devaluation. We've seen it time and time again, and everyone's talking about this. This is the big story, and it has been for so many years. Ben Bernanke and his money printing policy, his quantitative easing policy, and his famous statement of basically printing out money and throwing it out from a helicopter. So this is a nice cartoon analogy, kind of illustrating exactly that point. And of course, the big risk or the current consequence of that is currency devaluation. The more money you print, the more the central banks continue to produce quantitative easing, and QE 1, 2, 3, and now QE infinity doesn't seem to be ending. The more the currency value of that country starts to decrease, and of course at some point that does lead to inflationary pressure. The point is, though, does that inflationary pressure appear tomorrow morning, or does it appear after a year or two? Time is everything, and it's really important to keep that in mind. Ahmed's asking any view about the euro direction. I'm more negative on the euro over the next few weeks and months, and actually more positive on the US dollar into the summer months of this year. Again, my core scenario is that the US stock markets or Western stock markets might start to unwind during the summer period down to just potential downside risks from these high levels. And it also might be due to some kind of macro economic or political or geopolitical shock of some sort. Any type of market shock, or which would lead to an increase in volatility, such as the VIX, the volatility-based index, will unwind a lot of risk assets, a lot of risk markets, and risk trades such as the euro, such as the Australian dollar, such as sterling. But sterling is negative anyway, based upon the deteriorating situation in the UK. Which I think sterling dollar will actually, head down to 130. By the way, that's my expectation. So further downside in sterling dollar cable. Euro sterling is a tough one at the moment, but I think maybe Europe actually might continue to outperform the sterling, because I think things in the UK actually might continue to surprise. But euro sterling's not easy, but I would favor euro over the sterling over the short term. I don't have any price levels now, but I can maybe talk about them in future webinars. So currency devaluation is the last market shock that I've spoken about, but obviously it's the one that we've been talking about the most. Keep in mind that everyone is talking about the risk of all of this quantitative easing, but quantitative easing has been going on now for so many years, and so many trillions of dollars have already been pumped into the system. It's really important to ask ourselves the question: when the risk does actually show its face, when will it happen, and how will it happen? So obviously we are starting to see risks show up already, but this big inflation story, it hasn't happened yet. Of course, the cost of living has increased, but in terms of a big rise in interest rates and a big hyperinflationary situation, we haven't seen it. Doesn't mean that it won't happen, no, but just keep in mind that timing is really important when you're actually looking for trade or investment ideas. So just keep in mind, if whatever you think the scenario might be, it's important to have a timeline on when you think that scenario might play out. Okay, the last chart I want to talk about is, of course, comparative measure of the stock market versus commodities, or the U.S. Dow Jones Index, the Dow versus gold, or the famous Dow-Gold ratio, just showing you exactly what it means in real terms when we're in these kind of long-term bear markets or long-term sideways markets in the stock market. And it shows you that although we're at all-time highs in the U.S. stock market, in real terms, we're down at least 80% in terms of real tangible asset value. And so you can see here, when this chart goes up, it's the US stock market outperforming gold, and when this chart goes down, it's gold outperforming the US stock market. And of course, from the year 2000, from the beginning of that long-term sideways move, which lasts roughly 16 to 20 years, we can see here that the US stock market has lost about 80% in value, or just over, in real terms. And of course, partly the reason why we've seen the move up to all-time highs is because of this quantitative easing, this credit creation, which has just been extending indefinitely. So keep in mind that the types of strategies at this moment, even though we see the US stock market and other markets at all-time highs, the big focus is capital preservation, not wealth creation. Wealth creation was probably during the 1980s, 1990s, during the long-term secular bull market between 1982 and 2000, when we did see a big up phase in the US stock market over gold. And so this is where basically paper wins over hard assets. But at the moment, and since 2000, it's been hard assets winning over paper. So gold is, I think, a very positive market to keep in mind. But the other point, of course, is gold in the short term is looking a bit more bearish. Based on this ratio, it's also it may also suggest a potential resumption in the gold trend. Time will tell. But the key message here from a macro perspective, big picture perspective, since 2000, although we've seen big bullish moves in the stock market, in terms of real terms, commodities or gold have been the better play, and you can see it on this chart. That's my last slide. I always end off on the very philosophical mantra, enlightenment through realized knowledge. It's been an honor and a pleasure sharing this webinar with you, and I hope that each of you have enjoyed it. Any questions and answers, I'm happy to discuss maybe via email, because I think my time's up. Thank you very much, FX Street. It's been always a pleasure to share my ideas and to follow up with fantastic participants, each of you here from across the world. Thank you so much for attending, and I hope you've enjoyed this webinar. Keep in mind that the next webinar is going to be on Wednesday, the 24th of April at 2 p.m. At the moment, I'm thinking of doing another session on inflation deflation, a part 2. I'm still going to confirm, but this is very much a hot topic, and I hope that you have found it very interesting. Any questions that you'd like to have, please feel free to email me on ronwilliampr@gmail.com. ronwilliampr@gmail.com. And if you'd like to connect, I'm on LinkedIn, Twitter, and all the various social media sites. So happy greetings, everyone. Have a fantastic week, and I look forward to speaking to each of you on the 24th of April. And as the markets start to heat up, I will start to actually increase my webinars, so stay tuned for future webinars. Thank you very much, everyone. Thank you, FX Street. All the best. Bye-bye.